The Federal Reserve made another cut to its key interest rate today, now sitting at 3.9%. That's down from about 4.1%, and those quarter cuts starting to add up just a bit. Joining us live now, Chuck Zodda, managing partner with Armstrong Advisory Group. Chuck, it's great to see you. Thank you for being with us today. Let's jump right into this economic data because it's always very important. The feds will look at it in determining if they're going to cut or not, but hiring right now, not fantastic, hasn't been. Inflation is holding, but it's up a little bit. But the government shutdown now means that no September jobs report is available. We don't know about October's eventually. So tell us what this cut today is based on.
Well, I think Jay Powell referred to this as another insurance cut, effectively saying, look, the labor market has been slowing over the course of the summer into the early fall for the period for which we do have economic data. And given the fact that the Federal Reserve cut at their September meeting, a follow-on cut seemed to be the right move here. So where he did start to open the door for a wider range of possibilities is their upcoming December meeting, which is going to be 6 weeks from now. Basically, markets had been expecting a third cut, and quite honestly, I thought it was pretty likely that we would see one as well, simply because we weren't going to get too much more economic data before then. But Powell pretty much said, look, don't think that's a foregone conclusion. We might not cut at the December meeting. And so that has kind of changed the flavor of what the rest of the year looks like when we look towards that meeting.
Right. I was going to ask you about that because Jerome Powell indicating, hey, everybody, let's not go ahead and think on this is a sure thing, because with all of these parameters now that we're in, just don't know about that yet. However, with the cut being unclear, the timing is important here because that cut, if it happens, would coincide, of course, with the busy holiday shopping season. So if you were to have any advice for people out there, how to prep for these next few months, the shutdown continues. Borrowing, of course, might become a bit cheaper now with this cut today. But big spending, if you are thinking ahead, and it's likely on the horizon for many families as they look at Christmas and the holidays, what should we be doing right now to make sure that we are in pretty good shape for this?
So a couple interesting things just to talk about that. One of the things that we saw today actually is because Powell guided that the Fed might not cut at that December meeting, longer term interest rates actually moved up today. Mortgage News Daily tracks the national average of 30-year fixed rate mortgages. They went up 0.14% to 6.27. So mortgage rates actually moved up today despite the Federal Reserve cut. What do we see moving down? Typically, credit cards and other shorter term loans, those tend to have their interest rates in many cases, not all of them, but many cases tied to the Fed funds rate or a similar rate. And so you might see a slight decrease in the interest rate that is out there on credit cards, potentially meaning, hey, if you have to borrow and leave a balance on a credit card, maybe the balance is a little lower. But remember, the national average for credit card interest rates is close to 20%. It's not making a huge dent there. The one thing I will say about this holiday shopping season, because of changes to the tax code, things like no tax on tips, no tax on overtime, and expanded senior tax credits or tax deductions, you may see larger tax refunds coming through during tax season next year, depending on your personal financial situation. And so that can potentially give you some additional room as far as paying off debt that gets run up during the holiday season. But again, it's going to depend on the individual as far as what that looks like.
Chuck, before I let you go, let me ask you quickly about the markets. Booming right now. President set to meet with Xi Jinping, talk about trade. So a lot of balls in the air, but that's usually a red flag for investors. But we're holding really strong in the market. What's going on here?
Well, look, the thing I always come back to, there is always something to worry about in financial markets. I've been doing this about 16 years now, and there's never been a time where anyone's looked at markets or the economy and said, hey, everything's perfect, this is completely fine. So that's not to say that what we've seen for the last 6 months or so is going to continue or not, but it's more to say, look, just because people are worried about things, or if people, are starting to feel good about things, that's not really an indication of where markets are going to go in the future. Ultimately, markets are typically determined by two things: the rate of growth in the economy and the rate of inflation in the economy. When things start to look better on the growth front, things tend to look better in markets. When things tend to look worse on the inflation front, things tend to look worse in markets. So I think ultimately, what we're going to see next year is the question of, hey, with inflation still running close to 3%, if we start to see growth picking up in the job market and if housing turns a corner a little bit, does that result in more inflation coming through at that point? And could that be a headwind? I don't necessarily know, but look, there's never any perfect time in the economy or markets. If you're looking for that, you're just never going to find it out there.
Indeed. Okay, Chuck Zada, Armstrong Advisory Group, always a pleasure. Thanks for your time today.